שלומכם, רק את הפתיח, אני לבד אעשה, יואב יצא לחופשה קצרה, אבל לפני שהוא יצא לחופשה קצרה, הייתה לנו הזכות להקליט פרק מרתק עם בחור מכובד, מר טוביאס קרלייל, דמות שיואב מעריץ, אתם תשימו לב בהקלטה, בשיחה איתו, את ההתרגשות שלו. טוביאס, הוא איש שעשינו עליו פרק בנפרד, אחד החוקרים הגדולים של עולם השקעות הקוואנט, והמשקיע קוואנט בעצמו עם ETFים שלו. הייתה שיחה מרתקת להבין את העומק של הקוואנט, את תפיסת העולם המחקרית שלו, את האתגרים כשזה לא עובד. אנחנו חושבים שתוכלו ללמוד מזה המון. אז אני לא אפריע לכם יותר מדי, תצללו, תקשיבו לי, ליואב ולטוביאס, חוקרים את עולמות הקוואנט. אני אזכיר לכם רק שזה לא המלצה לביצוע פעולה כזאת או אחרת בנייר ערך, ולא ייעוץ השקעות ולא שיווק השקעות. אה, השקעות זה דבר מסוכן, אפשר להפסיד בו את כל הכסף, צריך מאוד להיזהר ולהתחשב במצב האישי של כל אחד. מי שרוצה לקבל ייעוץ אישי מוזמן להירשם למטה ולתאם פגישה עם יואב. בכל מקרה, יש לכם שם גם נותני חסות שמאפשרים לכם, הוספנו אחד אפילו היום, את מיטב דש טרייד למי שרוצה לפתוח חשבון מסחר ישראלי, שיאפשר לו לסחור גם בניירות ערך ישראלי, מה שאי אפשר באינטראקטיב, מצטרף לאינטראקטיב ולפספורט קארד, הספקים שאנחנו אוהבים, שאתם יכולים להשתמש בשירותים הטובים שלהם, במחירים טובים, ולתמוך בנו גם כן. אתם מוזמנים להירשם גם לניוזלטר שלנו, לעשות לייק, שייר, ולעזור לנו להפיץ את הרעיונות. אז בלי יותר מדי הקדמה, בבקשה, תהנו מהשיחה שלנו עם אדון טוביאס קרלייל. Hello, Yoav, and hello, Mr. Tobias Carlyle.
Good evening. Good morning to you guys.
Yeah, we're in
Gents,
the evening.
thank you for having me. Appreciate it.
Tobias, say
Thank
hello, Petach Tikva, on your podcast. You always have people from Petach Tikva
Is that
in Israel.
I'm mispronouncing it. Petatic.
Petach Tikva, say, yeah.
Getting it wrong.
It'll be interesting to know if the guy who listens to your pod from Petach Tikva is listening to us today. That would be interesting.
If
But,
so,
See,
please write in our comments.
I
Yes.
say Peta Tikva. That's terrible, isn't it?
it's okay. It's a tough spelling.
That's the best I can do. But that gentleman is always one of the first on.
I
So
know.
I'm very grateful for his.
For our
getting that note.
listeners who don't
And
know,
it's live. It's like in the middle of the night. Yes.
Yeah,
Please
yeah.
introduce.
we have the honor of interviewing a very great guest, a podcaster by himself and an author and investor that we talked about it a few times in our podcast before, Mr. Tobias Carlyle. And Mr. Tobias has a podcast of his own called Acquires Multiple, right?
Acquires podcast, although the one that I record with Jake is Value After Hours, which
Okay.
the idea is
Yeah.
that you're meeting
Yeah.
after a conference, like what you actually talk about.
Yeah, so then Tobias has the habit of seeing who is online because you do it live, right?
We do, yeah.
Then you see who's online from all over the world, and he has a very prominent listener from Petach Tikva. They always try to pronounce it. This is the Yoav's joke to the beginning. So it's a great honor to have you here, Tobias.
I always say this, Gilad, when we've had a previous guest, but really for Tobias, probably one of the people that have had the biggest influence on my misal investing.
Tell us why. Tell us why. Why?
Well, first of all, it starts off,
If
Tobias, I hope
you,
you...
I'll make it more accurate. If you need to introduce Tobias' work in a few sentences that influence you the most, what would you say?
I think that the first of all, the podcast today is amazing, and the people that you've had on, and the way you introduce the world of investing. But for me, going back, it's the book, Quantitative Value, Tobias, that you wrote together with Wesley Greer, who's been on the pod. A book that, in a very methodical and intelligent manner, dealt with what captured me most. I remember most is reading about the magic formula. We've talked about it here in Nuskhata Kesem in Hebrew, where Professor Greenblatt showed that with two very simple parameters, you could beat the market over time. And Tobias and Wes in their book back tested a bunch of different strategies, and first of all showed that Mr. Greenblatt's Professor Greenblatt's work is interesting, but it could be improved, and it can't be done again. You could that's gently you said that you couldn't see where he got his data from. Tobias, correct me if I'm wrong. And that book just sent me on a path, and then all your other books from the Acquires Multiple, Deep Value, your concentrated. What the title? I forgot.
Concentrated investing. That's it.
And we'll put, and of course we have the privilege of having him here because Tobias wrote a new book that I highly recommend our listeners read as well. We'll give the title right, Tobias, and so it's a longer one. It's Soldier of Fortune. I just finished reading it. Warren Buffett, Sun Tzu, An Ancient Art of Risk Taking. We'll maybe we'll talk about it a little bit later. But Tobias, really, who people don't know him, lo mekirim. It's a great honor. One of the more well-known investors, I think, in the States today. And he's also a practitioner. We'll talk about how we invest today, and I think it will be very interesting. But for me, I think I'm basically a quant due to your work and Wes's work, Tobias.
Well, that's a very kind introduction. Thank you for that.
I mean it, and I'm underestimating. I'm really, as you say, I'm emotional that we have you here.
Great. So, Tobias, we would like to give you the honor to open with the quote that we would like to open our podcast.
So it's hard to narrow down. I've got this. This comes from a chapter of the book. This is the most recent book called Via Negativa, which means by way of the negative. And then there's a Sun Tzu quote, which I'm going to give you. This is not the quote, though. This is just to introduce it. The Sun Tzu quote is, there are roads that must not be followed, armies that must not be attacked, towns that must not be besieged, positions that must not be contested, commands of the sovereign that must not be obeyed. And the idea is that it's all framed in the negative, and a lot of Sun Tzu is framed in the negative. And that's an important philosophical idea that has many philosophers have talked about, East and West. And Charlie Munger is really where I got the idea from in the first instance. So I want to give Charlie credit for that. And it comes from he often quotes Carl Jacobi, who's the mathematician, and he says, invert, always invert. And then he has this funny line about, I just want to know where I'm going to die, and then I'm not going to go there, which is a great idea. But the quote from Charlie that I wanted to bring up was, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. And that's really the essence of via negativa reasoning. You just try to avoid the mistakes rather than trying to do anything genius.
Great.
Which I feel is an easier thing to do.
Well, it's easier, but it's also harder in many ways, because the human nature is sometimes have all those cravings and wants and things, and everything looks glamour and you want to do it so it's easy to think about what to do instead of what not to do. Yes.
Which is a great, and you hit the nail on the head, and that's exactly the reason that it is so powerful, because it speaks not to the intellect, which is how smart you are, but rather to temperament or to character, which is the trap that many prominent people who've had very long successful careers fall into at the very end. And it's this little character flaw that is ultimately their downfall, and that's been repeated throughout history. And so that's one of the reasons why I'm systematic, and that's one of the reasons that I advocate for being systematic, because it takes away that ability to make that kind of mistake. You can make other kinds of mistakes, but it takes away that kind of mistake, which is the one I'm trying to avoid.
Nice. Yoav, you would like to give us your quote?
With permission of the author, I'll also take a quote from his latest book.
Please,
where you quote Buffett here, and I think it's a great spin-off to what you were saying, Tobias. You quoted Buffett by I think Buffett was quoting Graham, and one of them said, whether you achieve, you tell me which one of them, whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as on the amplitudes of stock market folly that prevail during your investment career. I'll cut off the end with your permission, but I'll say, was it Buffett or Graham, by the way, Tobias, who said
that's Buffett in the introduction to the latest edition of The Intelligent Investor.
Okay. Great. So I think I have a copy here. You've caught me. I haven't read the newest edition. Anyway, what I got from here and put and I think and put into current events is that during your investment career, if you want to do better, then you're going to have to sit aside sometimes when everybody else is going crazy, and that's when the real money can be made if you can sit aside and not
Or
get
lost.
washed away or lost. Yeah. So I think that I love that quote, and I feel like it's really relevant to what's going on today. Until NVIDIA,
We will,
yeah,
we
Well,
will,
I think The Intelligent Investor is one of the most incredible books that I've ever read. It's when you read Sun Tzu and then you read The Intelligent Investor, there's clearly a lot of that strategy in Graham. Whatever the strategy is that's in The Art of War, that's also in Graham. And the main idea is that you're avoiding ruin. That's really the focus of Sun Tzu and all of the ways that you can become ruined. And emotion is a big part of it. And so I think Graham also sort of recognizes the role of temperament in investment. And then a lot of the intelligent investors. So security analysis is really like the mechanics or the mathematics or the logic of investment itself. But then intelligent investor is the other, it's the squishier temperament stuff that may be more important.
agreed. That's
and we
why
will
maybe he
go
was all
deep into it.
Yep.
Yeah, we'll go deep
Yes.
into it. My quote is from Seneca, philosopher. It is not the man who has too little, but the man who craves more that is poor. And I do financial planning for families, and people tell me how much is enough for me to retire or to have enough. And I always ask them, well, it depends on how much you want to spend. I have people with $2 million that have more than enough, and I have people with $30 million who's not even close to be enough. And this is unbelievable, the amount of your craving and wants is what truly determine your wealth.
Yeah, that's also a great quote. I love that. I've got Seneca's letters to a Stoic. I think that's
Yeah,
what
yeah,
the
it's from Letters to Lucius.
letters to Lucius. Yeah,
Yeah,
I think
Letters to Lucius.
my edition is letters to a Stoic, but I think it's an incredible, really charming, funny little
Yeah.
letters that he writes.
Yeah, by the way, I have Sun Tzu here on the shelves and also the Intelligent Investor. So I think
It's a good
we share
bookshelf.
some, yeah, we share some great love of books. So basically, as you have mentioned, you work, and we will also put in the show notes your great talk at Google. I think it was like 15 years ago or 10 years ago or something like this.
2014, I think,
Yeah, yeah.
something like that, roughly.
Basically, you explain there in length why the science show and the research shows that buying cheap and ugly companies is better than buying good and glamorous companies. If I should summarize it into a sentence. And first, if you'd like to give us just the summary of this lecture from your perspective about why is that so, because it is counterintuitive to the human nature.
Yeah, so I wrote a book in 2012 called Quantitative Value, and I did that with Wes Gray, who I understand you've had on the show. Wes and I went and found every bit of industry and academic research that we could find on fundamental investment strategies and tested them because some of them they were based on papers that had been written in the 1930s, and they were focused on manufacturing companies, and we wanted to see, does that logic still apply? And unsurprisingly, it does still apply. And we made some tweaks though, because these guys had basically done a straight line linear regression and found all of these little funny coefficients that went beside, it does days payable blowing out. Is days receivable coming in? Like what of these things are the most important? And then they apply a funny, like it's a 0.29 coefficient, which who knows if that's true outside of that data set or not. Seems very unlikely that it is. But that's a credit. Altman Z score, Olson O score, it's something like a Piotrowski F score, those sort of things that are focused on credit quality and so on. And then we tested them, and they do still, the logic still applies. They may not be the right coefficients, but the idea is still workable and still works. But the reason that we're looking at these sort of little statistical measures is that there's this principle that you find when you go through the social science research. And so social science is anything that's looking at human behavior. And it becomes very clear that simple statistical models outperform the intuition of experts, which is very surprising. And then beyond that, simple statistical models continue to outperform experts even when they're given the benefit of the output of these simple statistical models.
Can you give us some examples to...
Yeah, absolutely. So the one that I always think of is patients come to a hospital and they can be depressed or psychotic. And those are two very different things, but depression in its very extreme instance, I understand, I'm not a doctor, but I understand that it can manifest as psychosis. So they might look very, very similar to somebody who's admitting this patient into the hospital. And they can make the diagnosis more certain as time goes by. So a week or two later, they could be, this person's genuinely psychotic. This person has an extreme case of depression. And the way that the doctor who was admitting these patients noticed that it was basically a coin flip whether the admitting doctor got it right. And so what they did was they gave them a simple checklist which had 6 or 7 questions that were, he had gone back through 1,000 of these admissions and found the sort of distinguishing features, and then he gave this 6 or 7 questionnaire to the doctors to apply, but then he gave them their own, you have your own discretion as to whether you accept this outcome or not. And so they used it, and they found that the little 7-question questionnaire was much more effective at determining, was made many fewer errors than the doctors without this little document. But even with the document itself, the doctors still didn't perform as well as the little questionnaire by itself. And so that illustrates the idea that there's something very powerful in simple statistical models, even though in any given instance you can find some reason why it shouldn't apply. And there are lots of examples that they give. So you might have an estimate about whether somebody goes to see a movie or not on a Friday night. And this is sort of interesting to people who produce films. They want to know how can we make money out of this film? What's going to prompt this person to go to the movies? And there might be lots of different factors, and it might be the amount of rain that's falling, it might be the style of the movie, the time of the year, there's whatever the factors might be. But in this particular instance, you know that this person has a broken leg. So will the person with a broken leg go to the movies that night? And you might say no. And you say, well, shouldn't I then be able to override the simple statistical model with this additional information that I have, that this person has a broken leg? And the answer is no. And the reason is that we find too many broken legs. We find too many reasons to override the model. And so that's and you can find this idea replicated over and over again through the social science research. And they find it in predicting wine vintages. So when wine is in its very raw state, it's hard to determine how good it's going to be. And they have these experts who taste this raw wine and then make a prediction about the value of it. And then they compared that to these guys who just looked at the amount of rainfall, the quality of the soil, the number of sunny days, and they were much more predictive.
And this is before AI even. And this stuff is even before
AI. Well, they're very simple. Some of these models are very, very simple. 6 or 7 questions, 6 or 7 parameters is enough to make these decisions. And you find it in criminal recidivism, somebody being released from jail, their likelihood to commit another crime. You find it in college admissions. Anything where you're trying to make a prediction about the future of human behavior. Humans making that prediction tend to make these little mistakes. And I think that the stock market is another place where it's very similar to that, where we're trying to make a prediction about a future state. Human beings are involved because they're impacting the price of the stock that we're paying, what we're paying for in this particular instance. And then we look at what happens in the future, and we find that in the market where the research that came out in 1994. So there are two competing ideas in the stock market, and they're probably both not entirely correct or incorrect. It's probably a blend of both. But the efficient market guys, the fama French guys, say that any outperformance is due to additional risk, where they define risk as volatility, but it doesn't really matter. Like they're thinking about deviation from an expected return being risk. So that's volatility, as they call it. And so they say anytime you have these outsized returns to a factor, and a factor might be value, which we would say might be, and you can measure that lots of different ways, but for the purposes of the study, they use price to book, and a low price to book is value, and a high price to book is expensive or glamour. And they say that any deviation that leads to excess returns is as a result of risk. And then there are the competing academics, and they say it's all behavioral. They say the problem is that people look at companies with declining earnings or declining share price or declining revenues, and they say those earnings, that share price will continue to decline into the future forever and ever, or it will continue to go up forever and ever. And so they're called in the literature naive extrapolation investors. And they contrast that with people who are betting on mean reversion, who say, once things have gone down a lot, the likelihood is that they start going back up again. Once things have gone up a lot, the likelihood is they come back to earth a little bit, because there is this mean reverting tendency in the markets. And it's not the mean reversion it's not purely statistical mean reversion where it's just enough observations gets you back. It's really, there's some behavior of the folks in the market. Plus there's a business cycle. And we just don't understand those things. And so we don't understand those things intuitively. And so to capture that effect and have it work for you, use a simple statistical model to identify undervaluation and various other things. And that's more predictive for the future. And that's essentially the focus of the talk, is just giving these different examples of what leads to outperformance and the behavioral drivers behind it. So quant always sounds like it's this very mathematical, statistical kind of approach to the markets, but really what it is just trying to avoid behavioral errors.
Mhm.
And you actually found, if you want to talk a little bit more, Tobias, about this one factor that in your various books and talks and now you use in one of your ETFs, I understand. I think maybe you can talk a bit more freely. You want to talk a little bit more about what this one factor that you found that you guys use today?
So this is the acquirer's multiple
Yeah.
So we tested all of the price ratios, you could call them. So price to book is a price ratio, and people might say, well, why would book value be relevant? Because book value is a historical accounting of what has gone into the business, written down. It has nothing to do with the future earning power of the business. Surely you should take that into consideration. And the academics would say, yes, but book value doesn't vary much from quarter to quarter. It's pretty stable, whereas earnings and other things move around. And so that's why they like it. And it's easier to calculate. It's pretty simple calculation. And there has been this association between low price to book value and forward returns. And there's some discussion about what causes that. But basically we've advanced far enough, or we've been considering it for long enough now, that we don't regard price to book value as the best measure of value. We can look at other flow measures. So you can look at price to earnings, price to cash flow.
I think that was the best one in your book, other than the EV/EBITDA one, right? Price to free cash flow, if I remember correctly.
Might have been enterprise value
Yeah,
to free cash flow.
that was the best one, but price to free cash flow is pretty close.
Cash flow is a very good one. And so we just took all of the data that we had, tested all of the price ratios that we could think of that people use in practice. And there were three that sort of stood out. And there's enterprise value. So enterprise value is market capitalization plus debt plus any preferred stock, minority interest. These are things that if you were an acquirer of the business in its entirety, these would be things that you would have to, it's value that you have to pay for in some way, shape, or form. You've got to pay for the debt. You've got to pay the minorities their share of the business. You've got to pay the dividend on the preferred stock. And then on the other side, so that's the true price that you're paying. And so there are many instances of businesses that the market capitalization might be quite small. So General Motors is a good example of that. When it went through the 2008 financial crisis, it previously had been a huge market capitalization, but as it struggled, the market capitalization came down quite a lot. But then it was still a very expensive business because the debt was gigantic. It had this enormous liabilities, and properly categorized, it continued to be a hugely overvalued business. It's just that none of the value is going to be captured in the equity anymore. And that tends to be a problem with low price to book.
Yeah, and PE as well. Because the market might get it right as well with the price, and it might be cheap just because it's highly indebted. Yeah.
Anything that uses price leaves you open to that possibility. So enterprise value is the better measure of what you're paying. And then you can compare that to what you're receiving on the other side is operating income, operating earnings, gross profits, free cash flow, operating cash flow, EBIT, EBITDA. All of these measures are rough variations of essentially trying to get to the same thing, which is what is the true operating, what is the income coming into the business that management can then use to either pay down debt or invest or whatever they need to do. So that measure has tended to be the best measure of performance. I think because it looks through to so many different aspects, and it's a very simple measure.
If I can stop for 1 second, just one thing is one that was we mentioned in past, but I think it's very important. Unlike the magic formula where Professor Greenblatt added a quality measure to the formula, where you're looking for cheap and quality companies, you found that adding this quality measure will just deter from your results. Totally, I think you said yourself that you were surprised by these results, and if you could explain, Tobias, here what you found.
So Greenblatt writes this wonderful book called The Little Book That Beats the Market, one of my favorite books. And it turned me, I was a lawyer when this book came out, and this was one of the things that I read, and I thought this is so the investment side where I was probably weaker, the valuation side where I was weaker, it turns out it's not that complicated. It's a simpler kind of approach. So Greenblatt's approach had been, what does Warren Buffett do? And he looked at Warren Buffett's letters, and Buffett has two things that he talks about all the time. The price that he's prepared to pay is essentially operating income on enterprise value. That's how he's determining the valuation on that side. And then he's determining quality based on the return on invested capital, return on equity, return on assets. You can play around with whichever one you prefer, but return on invested capital is essentially looking at what capital is essential to the business, what does it require, what can't be paid out, and then looking at that little invested capital, what does it produce in terms of the EBIT or the operating income on the other side. And the more it produces, the better the business. The more dollars that you produce, the better the underlying intrinsic invested capital, sorry. And so when he combined the two together, he found, and he had 14 years of data, and he looked at it from maybe it was 1992 to, and this was when it was a little bit more difficult to do back testing. And he found that it sort of outperformed the market in quite extraordinary numbers. And we took that idea in quantitative value and we tested it, and we found he was right. It definitely does outperform, not to the same extent. Our results aren't the same, but then it's difficult in back testing. We make lots of our own assumptions about what's investable and what's not investable. So you have to, if you're looking at uninvestable companies, and that's a question of liquidity and size and so on, you can find these quite extraordinary, literally unbelievable returns in there. And the problem is that it's not properly capturing the bid-ask spread or the true liquidity. And so you make assumptions about liquidity and the size of a company that might be investable. And you find that as you do that, a lot of the return disappears, but that's okay. That's just saying that the return might not be there in the same scale, but there's still any outperformance is a worthwhile finding. And so that definitely does work. And so we were just interested in, we were pulling that apart and analyzing it. And what is the driver of those returns? And it turns out that if you just use the operating income on enterprise value, so what I would call the acquirer's multiple by itself, you get better performance than using the quality.
Can you repeat it, please?
Yeah, so it's a funny finding. It's a very counterintuitive finding. And the idea is that if you use the two together, you get slightly worse performance than if you use just the value measure by itself without the quality measure. So the reason might be that there is some mean reversion continuing in these businesses. And so you see mean reversion at a business level as well. And often the market is aware of it. And so it'll be trading cheaply on an acquirer's multiple basis, cheaply on an EBIT to EV basis, and looking good on a return on invested capital basis. But that's because it's closer to the top of its business cycle and market participants understand this. And so those prior returns aren't going to be reflected into the future. And so all that taking away the quality measure does is it just takes away an error factor. And so you get, by just using the value factor, you get better performance. Now that finding that came out of a 2012 book looking at data to 2011. And so that was right at the peak of that performance for value. And so since then we've had value go down the other side. So I'm not entirely sure if we would have the same finding today, because it seems that what the return on invested capital side does is it helps you keep up with the market when you go through these extended periods. And so there was a little bit of research by I'm just blanking on his name now. I feel bad about that because I got the idea from him, but he looked at he did a similar sort of analysis where he broke down his name will come to me shortly. He broke down similar sort of analysis.
We'll put in the show notes, no problem.
To the one that I had done. Thank you. I'll have it afterwards. And he found that the outperform, it helps you keep up with the market during bubbly periods. So he looked at it through the .com boom, and where value guys would have been fired probably through that .com boom because they lagged so badly to an extraordinary degree. The magic formula itself sort of did pretty well through that period because it did pick up some of these companies that were doing very well. But the price of sort of keeping up with the market through most cycles is that you slightly underperform the raw value over the full cycle. So the question, then it becomes a little bit of a question of taste. Do you prefer very, very lumpy, volatile return streams that outperform, or do you prefer a slightly lower return that sort of keeps you a little bit more in line with the market?
I'm sure Gilad probably has a lot of questions. So I'll just put one thing. Art, I think the magic formula, I used it for many years, and it's also pretty much underperformed, at least when I used it. But we use in our investments, we combine value and momentum together. Another book by Wes and Schaeffer, and that's kept us out of some trouble during some of the time. It's not I do both pure with and without momentum. It's worked pretty nicely, but.
Do you do them as you don't combine them into one signal? You have two separate portfolios.
I actually use, again, I'm preaching to the teacher, but we use, first of all, I use a composite value, which has also helped us, I think, a bit. Mm-hmm. And we add on momentum factors. So we do both stocks that have both, just like Shanasi did in What Works on Wall Street, where he does
trending value.
Exactly. And it's worked very nicely. It's actually done this year, of course, but in the past few years, it's done very well. Yeah.
One of the reasons why that might be is that the momentum seems to be quite good at picking high growth in earnings. It seems to be slightly ahead of high growth and growing earnings. So I think that momentum, folks who are value and folks who are fundamental hear momentum, and it sounds like technical analysis. And to some extent, it is technical analysis. But I think that the way that you can become, and I don't use it personally, but the way that it has been explained to me by practitioners of it is that it does tend to be quite predictive of future earnings growth, which is a little bit surprising that the price in this instance predicts the earnings. But
Cliff Asness was able to tell Fama to imply that it works.
That's right.
So maybe,
That's right.
maybe we can, and yeah, we'll see over time. But for us, yeah, it's worked pretty nicely, and So
I
yeah,
think that was Cliff's PhD. Cliff was the one who
yeah,
sort of,
yeah, yeah. It was.
that's
He pitched
pretty,
momentum to the efficient market
yeah,
guy.
yeah, that's a challenge.
Gilad, go ahead. Sorry,
No,
we'll
no,
keep
I'm
us on track.
listening.
We can go on for
No,
hours.
no, I think it's very, very interesting. I want to ask first some questions about the backdating, back checking when you go and do such a
Yeah,
research, because they think sometimes God's is in the details,
yeah.
As you mentioned, you can do, when you do retroactively on data, you can make some mistakes. So maybe tell us a little bit about this check. How did you check it? I mean, how can you go and do back testing to this kind of portfolio and trades and everything? What's the process of analyzing it? I think it's very interesting.
We have there's lots of different data sets going back. So there's a data set that goes back to 1825, and at that time they weren't producing all of the financial statements, and we haven't saved all of the financial statements. So it's very, very spotty data.
Hmm.
And the only way that they can sort of determine value is by price to dividend yield. So looking at dividends. So that's a very imperfect data set. But then if you get to 1875, there was a gentleman, the Cowles Commission. He was trying to determine whether any of the newsletter writers had any predictiveness in their newsletter writing. And so they collected the financial statements that they had from 1875 to 1925, I think,
Hmm.
was when he wrote it. And then Ben Graham was able to use that data set to say some of the things that he did in security analysis and in the intelligent investor, where he had sort of determined that a low price relative to probably book value had performed quite well. And then from 1926 onwards, we have the Ken French data, which is the one that Famer and French used for their sort of their work in the 1990s, where their world was the risk-based world. And since 1926, we've been getting increasingly better data. So since 1963, we've had this like gold standard data set, which is point in time. And the significance of point in time is that when the filings are made, the system records when the filing is actually made. So, a quarterly filing comes after the end of the quarter, quite a significant period of time after the end of the quarter. And if you don't account for the fact that, you don't have last quarter's filings until months into the new quarter, then your system is trading ahead of when the people would have actually had that information. So it might look like you were
Hmm.
generating these great returns. So the first thing that you need is a point in time database.
Wow.
And then you need to we did various other things in quantitative value. So one of the things that we did was use the year-end data, which tends to be the best data because the quarterly is unaudited, can be revised. And then we lagged the trading until June. So the year end is December. We
Hmm.
assume that you don't trade until June, and then you hold for an entire year. And so that's trying to eliminate these various, they call them look ahead biases, various
Hmm.
biases that might be in the data. And then we try to trade infrequently. So it's not like trading daily or weekly or monthly. It's trading yearly, holding for a year to try and we're trying to be as conservative as we possibly can because we're looking
And
for
you
the
also
truth.
assume taxes on the sales and the buyers because of all the
W-
tax
We
issues.
we did not because taxes have changed over time and they're personal.
Hmm.
So your tax situation turns on your own
Yeah,
particular
I,
circumstances.
but
I
It's
if
not
remember.
you,
comparable.
I
but
remember Wesley. Sorry, I remember Wesley said in one talk that if he was in a tax exempt account, this is by what we manage mainly Tobias IRAs were tax exempt. So he said there, if you can do tax exempt and not have high trading costs, rebalance once a month, it may work even better. I
Yeah.
think you do once a quarter in your
Yeah.
strategies today. So
So I've looked at rebalancing as an important question. And I know that Wes rebalances on a monthly basis. I also know that you can rebalance an entire portfolio, or you can rebalance a slice of your portfolio. There are lots of different approaches. So you can have a rebalance period that's actually 2 years long, but rebalancing every week because you're only rebalancing one hundredth of the portfolio. And then people do various different things, time weighting there are lots of different approaches that you can take. I take a very simple one, which is just a quarterly rebalance of the entire portfolio. I find if it happens more frequently than that, it just increases the noise and the trading cost without sort of any commensurate increase in performance. And if you trade less frequently than quarterly, you have this problem where if you don't make a trade around March 2009, because that's such a deep low, and you trade, for example, in September of that same year, by which point there'd been this enormous recovery, your returns are about half. So it has this massive impact on trading. And Corey Hofstein has written this. He calls it rebalancing luck. And it's a quantifiable thing, the amount of rebalancing luck that you have. So quarterly, I think, gets us close enough to a low that we're okay.
Could be with or without GameStop. And I'm talking for personal experience. We had GameStop and we sold it way too early, and that could have changed.
I did exactly the same.
I feel like I'm in good company.
I had it the year before, and I can't remember the return, but it was like a 30% return, which is pretty acceptable. And then it went on to 10 or 100, whatever it did after that.
Crazy.
Okay, I want to summarize everything that you talked about into a few chapters and then go continue forward. So basically what you said, and it has a lot of sense into it, is that our subjective wisdom is very, very limited. Although it's very intuitive to us, it's very reasonable to us, it is something that our human nature can understand, that looks reasonable, it is mistaken. And when you use statistics and some database information, you should receive better results in almost anything. And I think that if we can look at the AI advancement in the world, we could definitely see that sometimes a kind of algorithmic based on statisticals can reach maybe smarter decisions than what we do. But what I, as someone a little bit from the outside, because I don't manage money directly and I don't use all of this, and I look at the side and I see that most of those research don't bring results in the actual portfolios that it is being manifested. I mean, if you talked about Greenblatt, he wrote the book, it looks great. But I think that ever since, it looks very, very bad. And so as a user, as an investor, as somebody that is investing in something that is severely outperformed, I mean, why maybe there is something flawed in the research?
I think that's a reasonable question. And I think that particularly for the research that I have done, the date is unfortunate, that the research, and I do think that this is something that plagues a lot of backtesting, that the results that you find are true to the date that you find them, and that outperformance is often disappears in the period that follows on immediately afterwards. And I think if we just step back from backtesting itself, we're all a backtester is just a way of learning about what has happened. It's like spending that time in the market. So it's a little bit like being there through that period of time and just seeing what happens. And I think that what I have seen is we have this data going back to 1926 that's pretty good. One of the things that really stands out to me is over that 100 years, there's been this advantage to being in smaller stocks. Smaller stocks tend to grow earnings faster. Larger stocks tend to be more stable, tend to grow earnings more slowly, but they're not as volatile. And so that's one instance where more volatility is associated with higher returns, lower volatility with lower returns. And over that it's 100 years of data that we have now. It's cost you about 0.8% a year to be in the biggest, and it's gained you about 0.7% a year to be in the smallest. This is relative to the index. So the smallest to the largest is about 1.7% a year. But over that full 100-year period, there have been these 6 very long reversals to that trend. And the longest one that we have in the data is 1945 to 1961. where the largest stocks outperformed the smaller stocks. And then the late 1990s is one that folks remember as being a period that reversed, because that was from 1990, 1991 through to 1999. There was a massive, it was a big market cap market. The biggest stocks outperformed.
91 to when?
To 99, to the top of the dot-com bubble.
The 90s, yeah.
So if we look back at that one now, everybody remembers it as a dot-com bubble, but it was really a large growth bubble because there were lots of companies that had phenomenal returns that had nothing to do with dot-com. And so GE was one. Microsoft, you could argue, was somewhat sort of tangential to dot-com. And Walmart is another one that really had nothing to do with dot-com at all at that point. And they all had these fabulous returns, traded at very high multiples. And then from the early 2000s until 2015, they went sideways. And it wasn't, the stock prices went sideways. And it wasn't anything to do with the underlying businesses, because they continued to grow about the same pace that they had grown before 1999. They were growing about 30% a year in their underlying businesses, which is extraordinary growth, but the stock prices didn't participate. And that ended in about 2015. And since 2015, which is about a little bit over 10 years now, it's been a big growth market again. Even though over the full data set, you lose by about 0.7% a year, for the last 10 years, it's outperformed pretty materially. And you can think of other periods of time. The Nifty 50 is a similar kind of idea, where it was the top 50 companies. Wonderful businesses, no question. Valuation got ahead of the underlying business. And so you have these very, very long cycles in the market. And they're so long.
Why do you think is that?
I think let me just, before I answer, give you credit. When I reached out to you, I think it was exactly 10 years ago, I told you I wanted to become a quant and do it on micro caps, small caps. You told me that it might not work as well with small caps. I remember you wrote, I have this email, I can find it for you. So you always give credit to Jake on the podcast, but you were prescient enough to say that. And I wanted to ask you why you were smart enough. You know, I went off and still did it, and it worked okay because I did the composite momentum, but you were right on. And
I think that a big part of what drives the valuation, what drives the returns, I think, is the differentiation, the difference between the most expensive and the cheapest. The cheapest do tend to outperform. So, but you do have to make an adjustment for quality. So in 2015, there had been this long value run that had sort of turned into a little bit of a value bubble, where people were overpaying for junky companies. And at the same time, these much, much higher quality companies, they were all trading at about the same valuation. The value spread was virtually non-existent. So you weren't being paid, the quality didn't cost you any more than junk. And so in that environment, you should favor quality. At the time, I didn't understand that. I wasn't far enough into my career.
So today's small cap junk, we're in the same position, right? You're 10 years ahead. That's what I feel recommend.
The spread is quite wide the other way. Now, I think that it's probably a pretty good setup for small cap value, and probably not a great setup for very large cap.
But I'm trying to understand, why do you think it is like that? Why there is times that growth and large cap is doing better than small cap and value?
I think there's a genuine revolution going on in the business, in society, in the business. The AI will certainly
No, I'm not talking about
penetrate.
now. I'm talking about in the 90s, in the 60s.
Well, that was
every time. Why is there different times when different kind of stocks is doing better?
It's technology. So we can go back to 1825, and we can see that was the installation of telegraphs and the steam engine. There have been these revolutions in technology. And those companies do come to the forefront. They do become the biggest companies in the market. And I think that is this is pure speculation on my behalf. But I think that, and this is just an idea that I've been working on for a little while, but I think it's pretty clear that the Magnificent Seven have grown far beyond anything else. And it's not unjustified. They really are. Those businesses are much bigger than every other business the business itself, I'm not talking about the market capitalization. The market capitalization is extraordinary, but the underlying business is huge too. I mean, I think in 2020, when the airlines got crushed, I looked at the airlines and they were $30 billion market cap, $50 billion market cap, which was like a quarter of cash flow for, might have been a quarter of free cash flow for Google at that point. They were just trivial relative to Google, and they've grown well beyond that since then. So I think that there's these tech revolutions really do reshape the business landscape and the stock market when they happen. But then, as we always do, we just get too excited about the long-term prospects of these things and forget that so who could have foreseen the impact that the internet would actually have? I think that in one sense, people were too excited about it in the moment, but probably didn't fully appreciate the true scale of what we can achieve with the internet 25 years hence. We're doing things now that we could never have conceived of in 2000 and 1999. And I think the same thing will happen now. As excited as people are, they're a little bit too excited for what we can currently achieve. But in 25 years' time, when we have kids who are native with AI, prompting and that sort of stuff, we'll be vastly, and we may have a different interface, but we'll be in a vastly different position. So it will reshape the business landscape. But in the interim, so at the moment, NVIDIA is 3 times the market capitalization of the entire energy sector, but the energy sector generates 50% more cash flow. Now, it's possible that, and this is on crushed energy prices, oil is trading at a very low price at the moment. I think it's just too excited about the prospects for NVIDIA, and it's possible that NVIDIA does keep on growing, but we're paying too much for those earnings streams, because ultimately the idea is that it's a financial approach. We're just looking at the ability of these businesses to generate income into the future and discounting it back to now.
So
We've just got a little bit too
I
ahead
want
of
to try to
ourselves.
summarize what you said, because I think it's a great observation. Basically, you said that the human nature, it works in such a way that is like Graham taught us in the intelligent investing. When it's optimist and everything is growing, he likes the growth and he likes the big companies and he's willing to paying for it more because he's very, very happy that it's going to grow. And then he overpaid and overpaid and overpaid until he suddenly sees that he doesn't have any return. Then he shifts and wants to buy the small companies that project some profits and are predictable and they are more reasonable buy for them. And then the cycle goes on and on and on.
And we could also add, so I could add that you don't even know who the beneficiaries will be. Even as we use the airline example, the airline industry changed the world, but investing in airlines was a really bad idea,
Yeah, yeah.
Buffett always says. So same thing could be said here. I think Tobias would agree.
Exactly. So why, maybe it is, as an investor, to try to go with the cycles. I mean, and not to just, when it's time for growth, to find the good growth, and when the growth peaked, to change to small cap value.
Cliff
Maybe
asked
this
us
is
sin a little
the,
bit, Tobias.
That's
maybe.
it. I think that's a great question. And it's really the question that drives a lot of investors, and people are trying to figure out what is the timing signal? How do we know to shift from one thing into the other? And I think that we're still at the point where nobody really knows. Nobody's figured it out. And the best approach is just to assume that you don't know what the future holds. And so to be sort of spread a little bit across all of these different things, which would be what Cliff would say. He would say, just come up with an allocation that whatever happens, you're okay with the future. And so he would, they say it's the path of
Less regret or something.
the path of least regret. Thank you. I was going to say the least objective programming. That's how you find something to watch on TV. It's the thing that back when you had to change channels, it was the thing that everybody hated the least. But it's the same idea. Like what is the thing that you will hate the least? And so you put all of them on, assuming that you don't know what the future holds, and that continues to be probably the best advice. But then Cliff, in that piece where he wrote Sin a Little, he was saying it's folly to try to pick these turns, but we are in this very, very unusual scenario where one is, and I think he would have said we're in the 125th percentile, which obviously that's an impossibility. It's the new 100th percentile, but he was saying, we're that far beyond what the old 100th percentile used to look like.
And he said
Perhaps it's
this
time
like
to sin
5,
a
6
little.
years ago. This paper was
Right. And it worked for a period of time, but it's
yeah,
reversed.
there was a year
Because
there, yeah.
one thought that comes to my mind when you're talking about the 100, when you describe
Percentile.
100 years of data.
Oh.
If you
Yes.
take everyone, so the small stacks outperform and the growth stacks underperform. But probably if we would take 90 years of data and start measuring in a different point of cycle, maybe we'll get a reverse outcome.
I think over 100 years, the peak that we're going through now, as extraordinary as this peak might feel at the time, when you look at it through 100 years of data, it's not much of a peak. You can see the dot-com peak, it's this little kind of bump, and you can see 29 as a little bump. And the overall trend is quite pronounced and quite easy to see. But I do take your point. I mean, the other criticism, which would be a very fair one, is that the best data that we have is for the US in the 20th and 21st century, which have been the dominant stock market performer globally over that period of time. So how representative is that data set of what is a global phenomenon? Probably it's too optimistic.
Mm-hmm.
Interesting. Tobias, I wanted to share with you something else about. We'll talk about maybe a little bit of quality. You're familiar. I think you've interviewed Dan Rasmussen and the Verdad guys, and I think you mentioned in passing. Tell me if you find anything, because this is something that interests me, and I think also our listeners, about these quality companies you mentioned. And he mentioned in thinking the data, he found that like companies with high ROICs over time, there is in the data numbers that show that these, like maybe the moats Buffett would call them, there is, and then he found that these companies over time, there is a possibility for them to continue. You can't, growth is unexpected and can't be forecasted, but higher ROIC, sometimes it can be forecasted. Are you familiar with something like this? Would you invest in such a strategy?
Well, Michael Mauboussin has taken this, he does this rolling 10-year analysis where he buckets them into 5 different groups, and the highest return on invested capital stocks, they show this mean reversion, but they continue to be the highest mean reversions, sorry, the highest return on invested capital stocks. And similarly, the ones that are the worst tend to stay the worst, although they have this very material improvement over that period of time. So there's a little bit of something in there for everybody. If you're a
growth, yeah.
If you're a quality guy, you say, well, the quality does persist. They do tend to stay good, better than everything else. And if you're a mean reversion guy, you say, well, there's quite a significant mean reversion on both sides. And so betting on mean reversion is also a good bet. So I think Dan and I are I've talked to Dan quite a few times. We're pretty similar philosophies on this stuff. And I think that Dan would say that mostly it's unpredictable, mostly it's randomness. And so given that that backdrop of randomness, paying a lower price for
it's more important.
Is a better idea. Yeah.
So let me take it to other edge. More important thing I want to tell you, because a lot of our listeners like the net strategy, and I know you started off with it and did great. And I always quote you where you said, correct me if I'm wrong, that if you when you bought like your nets, you handpicked them, you cherry picked the best ones, and you said a couple of times or wrote that if you just bought all of them, you would have done much better.
Yeah.
And so I use that also in my strategy. I want to connect it to also Japan and net strategy today. Many people say that they don't exist, but I want to tell you that from my personal experience, also in the U.S., if you manage a small enough amount of AUM or your own personal money, I think also in the U.S., like these biomed stocks that are like left for dead, you can still find money there. And where it has worked for us very well. And you wrote about Buffett buying Japanese stocks and taking the debt in yen and paying it with a dividend. So we did in Japan, a similar trade could be played, and we've done it with nets. You borrow in yen and buy their nets there, and it's done pretty well as well. So just I want to share that with you and
congrats.
what you think about that.
Well done. I think it's a great approach if you can put it on. I think that globally there's more and more better data globally, and I've watched
And
the.
you wrote a paper about nets. I didn't mention it. Sorry, I want to remember you. I think
That's
years
right.
ago you wrote a paper about nets. We'll put in the show notes. So I got to
That
give
was
you
the
credit for that.
2008 paper. I did an update of the Oppenheimer
Yeah, yeah.
had done
We'll
the
put in the
hand,
notes.
and it continued. It's funny, it continued, and our findings were virtually identical to his, even though that subsequent 25 years, everything had improved, the search and the analysis and so on. And we could probably, with any luck, I'll still be around for the 25th anniversary of that paper, which is not that far away. Funnily enough, it's like 2033, I guess. Yeah, that's a horrible thought.
Yeah.
Not that horrible,
So
not
this,
that
I
horrible.
probably will still work until then if
Well,
you're
I do
still
think
around and small enough.
I think it continues to work, and it works for the reason that it's a behavioral. Everybody, I look at the returns. They 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 like the idea conceptually, and then they look at what they have to buy, and that's the pause. They're like, oh my God, none of this stuff's going to work.
That's where you have to convince Gilad now. You have to. This is where Gilad. This is where
All
we
right,
have a lot.
try to convince me because I'm
He wants.
having trouble. Yeah.
He wants to buy Uber, and he said he before Buffett bought Buffett's that prodigies to buy
I
Google. He
think
was early.
Buffett's idea about Google came from listening to our podcast because I think like 4 months ago I gave a big thesis about Google being underpriced.
Well, I
Yeah,
think that's true. I think that he, I forget which meeting it was, but somebody pressed him about that in about 2021, something like that,
yeah,
and he said, and I think Charlie was on the stage too, and he said, we knew it because we were paying those prices for Geico. We were seeing that you had to pay $15 for a click or something, so we were fully aware and didn't do anything with it. I guess that you don't have to win every race. You don't have to participate in every single thing. You just have
yeah.
to wait until you get the ones where
The fat
you're
peaches,
certain.
the fat
Yeah,
peaches.
the lock. Yeah.
Yeah, yeah, yeah. But yeah, I feel, I think mainly it's about your mentality and your psychology because I don't know if it's right or wrong, but I can sleep better when I know what I owe. And when I know when it doesn't work, why it doesn't work. When I
Yeah.
own a company and I have a thesis that it's good, that its price is okay, that I understand the business, and then when it doesn't work, I know, okay, this was my mistake. This is why it didn't work. Maybe I'll wait more because it can change, or maybe I'll sell it. But it's easier for me to know what I own. And I think that my experience, you know, I have a saying that I said it many times on this podcast that the returns that you will get is not the returns of the underlying assets that you will hold. The returns that you get is the returns that your psychology and decisions will
Right.
make you do. You can hold the same underlying assets, but just sell it or buy it in a different time and will completely different way. So your psychology is far better than the choosing the underlying assets. And for me, understanding what as an investor, can sleep with is far more important. And when I'm looking at quant, I have trouble with not understanding why it's not working and need to assuming and working. And this is my psychology that sets me back.
Well, quant is a very broad church. That could be anything from
Yeah.
momentum to value. And I think that we've gone
But
through this very.
for me, what I group all of them in the same case of quant is that I buy the companies because the statistics told me, and not because I understand the business and know. This is the place that I have problem with.
But the value guys would say that we're just taking a statistic. We're looking at exactly the same thing you are. We're just doing it in a systematic, consistent way, so that there's no chance that we go nuts and start doubling down on something that's not working, or our style doesn't drift, which these are common things where people who underperform for a period of time, they swing for the fences to get out of the hole. They start gambling, they amp up the risk in the portfolio and the volatility in the portfolio. They start taking riskier bets because they want to get back to where they were. And the other thing is that they drift. So value might work, and then value's not working so well, and tech's doing really well, so they drift into tech, and paying higher and higher prices and not sort of appreciating what's happening because it's an incremental, and they just call that style drift. So I think that all that being a systematic investor is trying not to, don't get too concentrated and risky and swing for the fences, don't drift style, because really that's the fatal thing. You have to stay in the thing that you think works, waiting for, even though it goes through these periods of time that can be quite extended where it doesn't work. Because if you drift, then you're always chasing the thing that just worked, and that's how you guarantee that you continue to underperform. Whereas if you stay in something that hasn't worked, everything gets its market eventually.
Yeah, I totally agree. I think that the downside of my perspective is that you always need to work hard on your human emotions, whether you succeed or you're failed. Not to be too cocky when you succeed, and not to be too moody when you're
Right.
underperform, and
But
not and to restrain the human mentality is it's a difficult task.
But
a
you
deck.
can have the, sorry.
No, go ahead, Tobias. Go ahead.
I was
Sorry.
just going to say you can have the best of both worlds. You can have the rigor by having some sort of process that you go through, some sort of checklist. And I know that Guy Spear is an advocate of a checklist, and based on the work by Atul Gawande, who's the surgeon, and the pilots have checklists, and so they just have a checklist that you work through, and don't make any sort of decisions until you've gone through your checklist and have it in and out of any position. That would be the best of both worlds.
I think we have a little bit of a survivorship bias here also with concentrated portfolios, because the great investors we talked about in our early episodes, and some of them have come on, have been concentrated value, high research. The great investors we have, such as we talked about Ackman, Bill Miller, and Buffett, of course, and so on. And I think there is some survivorship biases. Most of these concentrated value guys are not only aren't going to overperform, they're going to probably not. They're going to quit very early, because over time it's just the volatility drag, and there's also concerns when your book to buy the concentration. Also, Gilad and I talk about it a lot. When you these great investors have like 10, 12 great ideas, high conviction. It works great when it does, but it's for I can't do it, and I'm not
No,
sure many people can.
this is too rich for my blood too.
Even
People who
25.
holds
Even
the
I found a paper. I think it was Dan who wrote about it. Who talked about, like, if you want to build a quality portfolio, even if not value, you probably do better. And I'll put in the show notes. Even then, with the quality, with like 100 stocks, you're gonna get your best bang for your buck when you're not highly
yeah,
concentrated.
about
And I,
100
but I know
bucks,
Hagstrom
but
has a different. He
yeah,
has talked about
it's
it differently, but
I think each
there is
one
some
need to choose
survivorship
what he
bias.
feels
That's what I'm
better.
saying. Everybody
No,
who
Yes.
listens here is, I
of
think.
course, definitely, definitely. I'll tell more than that, than survivor bias. I mean, you should be very smart to succeed in
And
this.
I think more and lucky, not in very
Well,
lucky as well.
of course, you need to be lucky in any strategy, but if you're not if you're not smart, you simply cannot do it. I mean, when you do a systematic one, like you talked about, and a quant one based on data, you don't really need to do the in-depth work of which is definitely not everyone can do. But it was amazing, Tobias, really, really in depth into the heart of the quant and statistics and everything. I think we couldn't talk to you for a lot more, but unfortunately, your schedule requires us to set you free for now.
But I do want to recommend for people, Tobias, not also we'll put in the show notes, to listen to your podcast. Just like you, we learn from you. We have a monthly. We don't send you send a weekly. I don't know how you do it. Who helps you? A weekly email with a bunch of great sources, podcast, investor letters, information. I just had an interesting one. I kept it open from the last one you sent out, which showed, I think you put on Twitter, a great follow on Twitter to buy for our listeners. If Tobias are pretty of great stuff, you put something from Jeff Winiger, who showed um, that last week the market achieved something last seen 1999, that the S&P beat the S&P Quality Index by over 11.5% over prior 6 months. When this happened 26 years ago, the snapback was violent. I'm sure. So lots of great. I think did you tweet this, or you put it in your newsletter anyway?
I,
So
I, I, I probably did tweet it But
Okay. Anyway, I'll put it out there.
The letter's collected by Johnny Hopkins. He puts it together for me. Yeah.
So that's great stuff, and I highly recommend we'll put in the show notes to people to get it as well and
To the
listen to your
podcast, to
podcast.
the newsletter, and to your books. I think you do a great job sharing all this knowledge, and thank you very much.
And
And
thanks for coming on, and send warmest regards to Jake, who's
I
a
will.
personal friend, and I'm sure the Israeli crowd will be will be
and next
listening to
time on
this.
the post, tell them Petah Tikva, Petah Tikva.
Oh, I'm gonna have to remember. I don't think I can even do it now. Just give me one more. Say it one more time for me.
Petah Tikva, Petah Tikva.
Like
Petach Tikva.
Petah Tikva,
Okay.
aywa.
Tobias, if you can hear in his accent, he's not he wasn't born in L.A. Like, you know,
Yeah,
he
yeah.
was
That's
born
right. That's right. I'm
in
Australian by
Australia.
birth. Yeah.
You can't miss. You can't miss it.
That's a tough one.
Yeah.
Amazing.
Tobias,
Thank you so much.
very, very much for your time. It was a great
My-
talk, very
My
inspirational.
pleasure.
And
My
of course,
pleasure.
we'll send it to you. And if you have anything to add, we'll be more than happy. Thanks again. Have a
Yeah,
great day.
I've Gilad. It's been an absolute pleasure. Thanks so much.
Thank you
Bye-bye.
very
Good luck with the
much.
book.
Yeah.
Thank you.
Bye bye.
Bye bye.
See you guys. Thank you.